Hi, I'm Chris Mather, and this morning we're going to talk about venture capital, which is a term that a lot of you have probably heard, and today we're going to try to get you to a point to where you actually understand how it works. And it's the kind of capital that funds very, very speculative type investments, things that you don't know that are going to get big. And the famous ones are people like Google and Facebook and Twitter, but it does a lot of other technologies. And here in Northeast Ohio, we realized about 10 years ago that as the world was growing through venture capital, we were not participating. And a lot of work has been done in the entrepreneurial ecosystem here in Northeast Ohio, specifically to focus on our ability to attract venture capital. And the results have been stupendous, that we have gotten renowned for not only our very early stage structure, but in the actual venture capital that we've raised. So in talking about venture, it is not the same as normal financing. If you start a business, you start a restaurant, you're not going to get venture capital financing unless you've got an idea that the restaurant, and you can sell it, that the restaurant's going to proliferate throughout the country. It is not usually businesses that can do what we call bootstrap, which means you basically get some from revenue and that lets you invest and that lets you invest. And that's how most small companies start. This is for high risk, high reward type ventures, and typically it's a breakthrough idea or technology. If you've taken some classes in business, this is going to break some of the rules. What you do to either present to convince, and to inform venture capitalists is sometimes a little bit different than what you do in other businesses. Almost always it's a breakthrough idea or a technology. It's something that solves a problem that couldn't be a problem before, something that changes the cost equation significantly, or it's the ability to run fast. It's a very clever run fast idea. The best examples that all of you deal with in terms of social media were really run fast ideas. If you think about it, eBay is pretty old now, but eBay was just first to market. Other people tried eBay, but it only made sense to have one central marketplace to buy and sell things until Craigslist came along. And that was one that was not venture funded because they're a nonprofit, but the idea is kind of the same because Craigslist does something a little bit different. Facebook, actually, MySpace was there before Facebook, and there were others before that. But Facebook ran the fastest and got there. So there's cases where you have that. But generally, it's intellectual property protectable. And you've had a class in this series about intellectual property. When it comes to medical devices or advanced materials or energy solutions, typically you're looking for things that have patent protection. They do look at a management team to run the company. In the end, it's probably not the founder, which is a little bit different. So you find the company, you get it started, and then the venture capital people tell you that it's going to be a different CEO. It's a tough situation for all people. I had the opportunity in my career to be that brought in CEO. So I know how to run the company, but I was not the founder of the company. The founder of the company was a Rhodes Scholar physicist. Not the right guy to run the company, but certainly the right guy to develop the technology. And then usually they're companies that need a lot of capital. Venture capital funders typically take the approach that it always takes twice as much time as twice as much money as you're telling me. And actually that's usually if you're doing well. So it's a little bit of a different kind of an environment. And there are other ways that you can fund the company. One way you can fund these very, very high growth companies would be through grants. So the National Institutes of Health for biomedical type research, the Department of Energy, the Department of Defense is always looking at new things, and a lot of things that soldiers have in the field 3 or 4 years later we get as consumers because they figured out how to use the technology and then to make it low cost. Night vision equipment is a great example. The military has had night vision equipment for years, but just in the last few years have you seen it in hunting stores and things like that. There are programs called SBIR and STTR, which are actually government programs that fund commercialization. They fund early stage companies. And they're great programs to get money into the company. So the pros on it is it provides cash for things that you'd have to do anyway. A company that I ran, we did a lot of SBIRs, and they were fundamentally paying us for what we needed to do to develop our product anyway. But the Department of Energy, in our case it was Department of Energy and a few others, wanted data on what we could do, so they funded our commercialization. And it does offset cash. And the problem with these companies is, and it's different than you think of other business, they eat cash for years. They don't just go off and start making money. Now, if you started a company tomorrow and you told your investor that you're going to eat cash for the next 2 years, so you'll be consuming cash, not making it, they won't be all that interested. Venture capital investors, that's exactly what they do. Now, the cons on these kind of grant programs is that they can be a distraction. They're difficult to manage. They're government programs. You've got to provide reports. So there's a lot of things you have to do. So there's kind of pros and cons to deciding to finance the company. And so you might decide to use investor funding. In investor funding, you start off, you usually use your personal savings. That's just what people do. You often go for what are called friends and family, and a lot of people add a third F to that. It's friends, family, and fools, because there's a lot of risk in this investing. You do have funders that are called angel funders. These are people that are typically high net worth individuals, often somebody who's done well in a company. I'm guessing Mark Zuckerberg could be a great angel funder, so he's got a lot of available cash, and he may invest individually in a company that he believes in. The terms from an angel funder are generally better than they are from venture capitalists. They ask a lot of the same questions. They usually have a lot of more flexibilities. And then there's venture capital. And so at this point, I'm going to ask a question for those of you in the audience. Your perception of using this high-risk venture capital, how many of you think that's a pretty good idea to fund these ventures? Okay, so a lot of people, not everybody, but a lot of people kind of believe that it's a good idea. And I'm going to give you the pros and the cons, and we're going to test and see what you think about that later. But let's kind of go through a real example of how this funding tends to work. So it is high-risk capital, and they're looking at these high-risk but high-reward type ventures. I mean, obviously Facebook was high-reward. The people who invented pulse oximeter, which anytime you go in for any kind of procedure, they'll put a little thing on your finger, and that's called a pulse oximeter. That was a venture capital funded device, and I'm sure they made a lot of money on that. So it is high reward. They're typically high touch, and what that means is that they come to see you a lot. When I was CEO, it wasn't always the best day when my investors showed up, because I was on stage. I mean, this is a test, and they're testing everything. They're very involved, but they're also involved in getting you in front of people that maybe you couldn't get in front of otherwise, so there's a lot of advantages. And it typically comes in stages. People think of big venture capital rounds. They hear that a company has raised $4 million, which is awesome. And that's actually a small amount of money. And then later on, they're followed with $20 million. Before that, they've gone to what's called seed and pre-seed money, which means that it's taking a little bit of the risk out of it for the venture capital companies. And these days, often those seed and pre-seed investments are made by not government entities, but usually nonprofit entities. People like in the Northeast Ohio, like JumpStart and the Innovation Fund at Lorain County Community College, are typically making these very early stage investments. And where do they invest? Probably where you'd expect. Biotechnology, pharmaceuticals, medical devices, big. Software is also big because you usually can't get intellectual property protection on software, so it's that run fast strategy. It's be the YouTube, be the Facebook, be the Twitter of the world. Clean tech and energy over the last few years have been very, very big. You see some media and entertainment. If somebody has a great idea for a cartoon company, for example, they might be able to get venture capital funding. A lot in electronics, some consumer products, but once again, it's got to have that compelling, high growth kind of a message to it, in some consumer services. But the biggest areas by far are software, medical technology, and energy. And typically, if you go through the process of how you tend to develop your products, you start off, you have an idea, and then you're trying to prove the concept that it works. That's when you're going to use your personal friends and family money in the grants. Eventually, you get to a proof of concept where you see POC, and you actually have a working prototype of whatever it is you're trying to sell. And that's when you're going to go to the JumpStarts and the innovation funds, those pre-seed structures, and maybe to angel investors to get money. Once you get to where you're actually developing the product and you put together a business model, so you not only know that you have a product, but you actually have something to sell, and you know how you're going to sell it and why people are going to buy it, that's when you go for Series A and Series B and C venture capital financing. And when you're ready to enter the market, your need for money actually goes up. So even though you're bringing in lots of money, you're typically spending more. And that's when you need what's called Series B. So it's basically the second major venture capital financing. So it wouldn't be unusual for you to drop $100,000 early on and you get some money from your family and friends and maybe get a grant from the government for $100,000. And then you go to a structure like the Innovation Fund, you get $100,000, followed up by $250,000 from JumpStart, usually with another $250,000 from JumpStart. or 500,000 maybe from an angel investor, so you've got about $1 million in the company, and then you go for your A round of funding, which may be $2 or $3 million. That's a typical path that you might follow. Now, what comes with venture capital? So I asked how many people liked it. The good things is it finances your idea, and it's with money that it's unlikely to be available anywhere else. It lets you do what you need to grow the company. So rather than spending all of your time worrying about money, you do have a bank account with a fair amount of money in it in some cases, so that you can grow the company. And it lets the founder have this great idea and have them participate in the company's high growth success. And from the venture capitalists, you often get connections to industry experts, so people can kind of either look at what you're doing and give you advice, but better yet, maybe give you some market access. And you maybe get connections with people who've done it before. Venture capital companies have what they call portfolios. So typically they'll have, I was a portfolio company CEO, and I would go in and I would meet with other people that have done it. And that was my first experience raising venture capital, not my first experience running a company. But I just found it helpful to talk to people who had done it before, who had been through how you raise funding. And it was extremely valuable for me, and the venture capital company gives you those connections. Now, there are some downsides, and the biggest downside that everybody goes to is that founders give up a significant portion of the company. They're investing for a reason. In the latest presidential election, you might remember Governor Rick Perry of Texas called them vulture capitalists. I can say that Mr. Perry didn't really understand how this works. Very clearly, he just doesn't understand it. Mitt Romney, that was not a venture capital company. Bain Capital was a little bit different. They're funding things that are bigger and more developed than this. But you do have to give up some of your company. And if you have a situation where you don't perform, you have a chance where actually you're not going to own most of what's in your company, or you might even be out. That can happen. So there's a lot of people that are careful about taking venture capital. And those of you who didn't raise your hand, you probably might know that. There is a negative aspect to that. And you've got involvement in the company. This is your baby, and this is your idea. And outsiders are involved. They may be helpful, but you may not think they're helpful. Attracting the capital is a difficult process. I can say when I was a early stage raising capital type of a CEO, I spent 80% of my time raising money and 20% of my time running the company. It's just a very, very difficult, involved process, and they expect performance. The worst thing that can happen is if you don't perform. Their expectation, as you said, when you make your presentation, it's going to be this big, it's going to be awesome, it's going to go great. They're expecting that to happen. So with that, let's talk about what are some of the basic capital terms. And you guys are actually ahead of a lot of other people. I've talked to many people in the industry who don't understand this. There's a couple of things that are typically in a venture capital deal. One is they're going to invest a certain amount of money and they're going to get a certain percentage of the company. I invest this, I get 20% of your company. And that's the fundamental of the deal. But there's an important thing called a liquidation preference. And what that means, typically, a 1x liquidation preference means that if I invest $1 million in your company, when we go and we sell the company, and that's usually where venture capitalists, that's where they want to get out. They don't want to be invested in the company forever. They're looking for some event, either going public, like Facebook recently did last year, or more likely that you sell the company to another person. They're going to first get their $1 million back. So I put my $1 million in, I get a percentage of the company, I get my $1 million back, and now we split all the money. And that's an important aspect in these deals that really drives, and you're going to see, that drives the math in these deals. Typically, if I give you my $1 million, it's also at an interest rate. So I'm getting interest as if I've loaned you the money. It's a typical market rate. So they're not onerous, but it's anywhere these days from 4 to 7%. And they're going to want to attract other management to the company. So they're going to have some kind of a stock option pool, and that'll be required in any given deal. So given that, let's start a company. So we have a company called Great Idea Company. And Liz, I'm going to ask you, could you be Joe founder? I guess you're Jane founder, but okay. And Andy, I want you to be, you're the technical person. You're a co-founder because she's running the company, but you're heavily involved and you kind of develop the technology. And you guys have gotten, somehow you've made a deal with your friends and family without a lot of fanfare that they have 20% of the company. They've given you some money to start and that's what they own. But you realize you need some venture capital money. So let's go through and you get this company called Early InvestCo. Says, and by the way, you guys will know more about the math of venture capital in the next 5 minutes than almost everybody in the US, so you're going to be way ahead of the game here. But early Invesco says, I'm going to invest $500,000 in your company, but I want 40% of the company. And I want a 10% management pool. So how does the math work? There's a couple of terms that are used. One is called your pre-money valuation and your post-money valuation. And people get these terms confused, and it's really, really easy math. If I give you $500,000, and that gives me 40% of something, if you divide the $500,000 by the 40%, then that says how much your company ostensibly, after my money comes in, was worth. So if I give you $500,000 and I get 40% of it, so therefore ostensibly the company after that money comes in was worth $1.25 million, 500,000 divided by 0.4. And that means if you take away my investment, since the money just came in today, your pre-money valuation is $750,000. That says that somehow you guys made this company worth $750,000 to somebody just through your sweat and through the work that you did in your idea, which is really good. So how does the ownership go? So I get my 40%, and everybody else has what they call dilution. So I want a 10% management pool, which means we're going to attract some different management. You might need a marketing VP, you might need a director of operations. It's possible that we have to bring in another CEO. So we need 10% of value of the company so that we can attract those people to probably take a little less money than they could get in the market to be able to participate in this company. So now, Jane, founder, you're now down to 35% of the company from your 70, so you've been diluted by 50%. Andy, you're the techie guy, you're now down to 5%, and your friends and family are down to 10%. The math works the same for everybody. That's called dilution. Your bet is that now that you have some money to work with, you can make this much more than twice as valuable so that your dollar stake is actually about the same. So that sounds pretty good, and what venture capital investors look for is an exit. The exit can be going public. It almost never happens these days. Facebook is an anomaly. You might see big, what are called IPOs. You might see 10 or 12 a year these days. In the early, in 1999, you were seeing hundreds per month, but it's just not what happens. Typically, you're going to play to where somebody is going to buy your company out. So if you're making a medical device, a company like Boston Scientific or Medtronics may come and say, we want to buy your heart device, and that is a big day because that's when everybody gets paid. So let's say that you grow the company, it was worth $1.25 million, and you get these guys to buy your company for $4 million. I'm guessing you're thinking this is a pretty good day. So what happens is, because of all those things that I mentioned, early Invesco gets $1.9 million. So they get 50% of the proceeds, but if you'll notice, they had 40% of the investment. And that's because of those liquidation preferences, because they got their $500,000 back first. So what happens, we took that $4 million, we paid the venture capital their $500,000 investment and their interest, and then we split along 40, 10, 35, 5, and 10%. We split that money after that, and so in that case, the management pool got $336,000 to split. Liz, you get $1.1 million. I'm assuming that was a pretty good day for you because you can do something. You're probably going to do your next company, but it's a good day in your household for sure when you come home with a $1.2 million check. Co-founder Techie, you got $168,000. That's a bonus, and you still have the ability to go do it, and you're probably going to continue with the company as it grows, so I'm guessing that's a good day for you as well, Andy. And your friends and family got paid $300,000 for their relatively modest investment, so everybody's happy. Well, let's say you only can grow the company to $2 million. So the company was worth $1.25 million when the venture capital money came in, and you grew it to $2 million. So you grew, but not at the rate that they're really looking at. Well, early Invesco then gets $1.2 million, 1.184, but they get 59% of the return. The management pool, $136,000. Liz, now you get $475,000. I'm guessing it's still a good day for you, but it's not really what you had in mind for the last 4 years, because realize you just divide that over 4 years, and that's an extra, $125,000 a year. It's okay, but it's not really what you were playing for. So you have to perform. Now, in a disaster scenario, or that you can only sell the company for $1 million, it just was, so literally your company over the 4 years has gone down in value, and this happens, and it's ugly, and the math is not really good. Liz, you got $125,000. My guess is that's not at all. You're not you'll take it, but it's not really what you had in mind when you started this company 4 years ago. And everybody else is lower than they expected. Early Invesco, the funny thing is that they got 78% of the return on the sale of the company, and for their $500,000 investment, they got $784. They're not happy either, because they spent a lot of time fooling around, and that money was being used in this company that didn't do all that well, and instead could have been used somewhere else. So this is a case where not everybody's happy. So this kind of gives you a sense of how it really works. And these numbers are made up to be simple, but they really are how it works. And you can see that what happens is it depends on how you do as a company. I didn't put a scenario in here if you sold the company for $10 million, but trust me, it's a really big payday for you guys. So let's say, but more likely, you get to a certain point with your company and you still need more money. It's just what happens. Medical devices, you might use your early stage venture only get to animal trials. So you've never even tried your medical device or your pharmaceutical in a human in your first round of venture capital, so that you usually have multiple rounds. So let's say that you need a follow-on round. So you have the ownership the same as before, after we entered the investment, because nothing's happened. We haven't sold to anybody. So early Invesco still owns 40%. Liz, you still own 35%, and so on. And then you come in, and Jane VC says, we're going to invest $2 million in your company, and we want 40% of the company. And you will see Jane VC and Early Invesco doing a lot of negotiating, and it's not always, in my company, our follow-on investor and my old investor hated each other by the end. It wasn't a lot of fun, because I was like the child watching the parents fight, because I had to have good relationships with both. Excuse me, same math. So she invests $2 million, and she wants her 40%. Same math as before. If she's investing $2 million and it's worth 40%, it says ostensibly the company's worth $5 million. So you've grown the value of this company. When the first guy invested, it was $750. His money came in, it was worth $1.25. Now, before the money came in, it's worth $3 million, because I take away her $2 million. But after her money comes in, it's worth $5 million. So you've grown this company in value from the 1.2 million up to 3 million. So you've done a pretty good job, and everybody's pretty excited about where it can go to the next level. Same exact math as before. In this case, it's still a 50% dilution. So Early Invesco's 40% stake becomes 20%, and they get they still keep their liquidation preferences and all the things that go in the deal. There's a new management pool, because they're saying we're going to hire even more people now, so they need to up that. But the old management pool still has their stock. And Liz, you still have your stake, but your stake's now down to 17.5%. You probably are on the board, but probably what your board looks like, and that's what controls the company, is 2 people from Jane VC, 1 person from Early Invesco, the CEO, in this case is Liz, and then 1 outsider is typically what the board looks like. So one thing now, you're in a case where you can get fired. Because the board could vote, even despite your vote, you could be put out of the company, and it does happen. Not expected, because we know you're a really good CEO, but it could happen. So that's what the math looks like, just like before. And let's say we go through the same math. You grow the company, and the company sells for $20 million, which I would say is a modest success. Not tremendous, but it's a modest success. Jane VC, same exact math. I won't go into all the details, but they get 46%, even though they only own 40 for the same reason, because of the liquidation preferences and because of the interest. Early Invesco, same thing. Instead of their 20, they only get 21%. They've been diluted pretty significantly. So, but Liz, you collect almost $3 million. So I'm guessing this is a really good day at your household, because you'll take that $3 million, and I don't think you're going to quite retire because you're too young, but you certainly have some financial stability and ability to do things that you've never had before. Andy, in your case, where you were one of the founders of the company, you bank $500,000, and it's the same thing. You can still go do the next one. So it's a good day for you as well. Everybody's celebrating. It's a really, really good day, because you're all ready to go on to the next company with bigger pocketbooks than you thought. Your friends and family, you're distributing $800,000. So at Christmas time, you're just a very, very popular guy in the family. But let's say you have the same thing, that you stumble a little bit, but it's still worth something. You grow the company, $10 million. In this case, Liz, you still get $1 million. It's a good result. It's not really what you thought, but you doubled the value from after the money came in from the VC, and everybody's pretty happy. It's just a little bit more modest. Same thing if you go down and you can only sell the company for $4 million. So the $4 million before was pretty good result, if you remember, from when we only had one investor. But when we brought in a second investor, which dilutes everybody a lot, the $4 million results are not that great. In this case, Liz, you only get $130,000. So you are bitter at this point. You're not happy about how this went at all. But then again, you have to own some of the performance because you've been CEO of the company. Andy, you know, you get $70,000, and that's okay, but it's really not kind of what you had in mind. So so that's kind of how this math works. So then I'm going to ask the question: how many think now that venture capital is a good way to fund the company? Now, and I see some hands that went up that were not up before, because you realize that it's how you fund it, and you can have a win. But I also saw a few people. One person over here is going like this. No way. Don't want to do that. And that is where people go through it's a very emotional kind of a thing, and it really depends a lot on your performance. The math is not always in your favor, but now, and this is where you get the terms like vulture capitalists. But now let's look at it from the venture capital side. They raise money from high net worth individuals and foundations and pension funds. The Ohio State Pension Fund, I guarantee the State Teachers Pension Fund has some money in some venture capital, not a lot, but some. And they're raising money from them, so they're called limited partners, and they've got to go put together a portfolio of these type companies and make it work. And they're going to go, and they're looking to say that they're going to get a 10x return on every single deal. That's what they're asking the question to see, how do I get 10x my money? And here's why. Because a number of those companies are just not going to make it. The best you're going to do is sell them for scrap value. And if anything, the numbers I'm going to show you are probably too high, because in some cases, the venture capitalists literally walk away and get nothing. There's just nothing there. Somebody else's intellectual property was better. Somebody had a better way to do it, so there's not a lot of value to that. Or the management screwed it up, or it was an idea that was trying to compete with Facebook and it didn't do so successfully. For every Instagram and Twitter and Facebook, there are hundreds that just don't make it. They're all good ideas. So those, and I've done this presentation a lot around Halloween time, so this works well. Those are kind of the rest in peace. You know, those companies are dead, and you're lucky if you get even the $500,000 out of it, you're doing pretty well. So they're investing, you know, $1 million or $2 million in each of these companies, and these companies have no value. And that's after numbers of years. Then there's another set of companies that are called zombies. And zombies are bad because they're alive, but you can't easily kill them, which is not true of zombie movies because you can easily kill those guys. But this is a case where they're just kind of the Walking Dead. Maybe they've introduced a product. We thought they were going to be $5–6 million, and they're selling $800,000. They've got a few employees. It's okay, but it's not really what you're looking for. And these numbers are probably a little bit high for what you're going to get out. So this is actually saying, you know, this is how you get good returns. But you do have a couple that are wins. My company was a single, or probably a good single or a double. So we made some money. So we made the venture people some money, and we all made some money. But you know, you get something out of them. So maybe that company, you put the $1 million in, you can get the $4 or the $5 million or even the $7 million out of it. And let's say you have that last company that's a home run. Now this is not a Google home run. I mean, Google, there are big home runs when that happens, when you sell the company for $1 billion. But if you can sell a company for 15 million, this is probably not a bad portfolio. So after 7 or 8 years, they're going to go back to their limited partners, and they say, hey, we got a compounded annual growth rate of 21%. In this kind of venture, that's what you're looking at. Because if not, I'm not going to give you my money to invest if you can't give me a good chance of getting 20%, because I can put it in the bank and get something. I can put it in a mutual fund and probably get 5. So you put all this together, this is what the VC's looking at. They had one home run, so only 4 of the companies were really successful, which maybe is even high. And that's the only way they can return to their investors. That's why they look for those really significantly onerous terms. If you perform, everybody wins. If you don't perform, everybody loses. The venture capitalist doesn't lose as much as you do, which is why a lot of people say, I don't want to do that. So you can see that venture capital is got some pros and some cons, and hopefully you've learned a lot about the math. I think you guys now know more of how venture capital works than 99% of the US population. So it really, in all honesty, can be a way to fund your company and to fund growth of regions. So that's going to be the end of this presentation. In the next presentation, we're going to talk about that if you've decided to use venture capital, what are the things that VCs want to see in your presentation? And we're going to talk a little bit about how that focus on venture capital financing has driven a lot of growth in Northeast Ohio, such that we're a great place to raise venture capital and start an early stage venture.